beloved, managing committee member, past treasurer, Ramji is going to talk on budget analysis as per the recent budget on the area direct and indirect taxes today. I have a lengthy profile of Soumya, but I think you would have read it. But anyway, I have to read it again because such a nice profile. Okay, so Soumya Mahapatra is a chartered financial analyst and has a PG diploma in Indian Institute of Materials Management. He is a gold medalist in BA Honors in Economics. His area of interest is international finance, creative financing, and innovative supply chain solution in storage and fermentation. Mr. Mahapatra, I went through your profile. I think you traveled across multiple domains in multiple areas, and become an expert. I think you served that respective industry. So he joined civil services, that is IRS, in 1984, and rose up in the ranks to occupy high position at the Income Tax Department. After a short stint in various jobs in leading companies like Maruti Udyog Limited in shipping, logistics, and imports. He left government services during 1998 and joined World Bank. He specialized in ports, containerization, and infrastructure. By 2001, he ventured into own business and set up international trade with Evol Globe Private Limited, Singapore. He built and scaled up business in timber trade, organic coffee processing, and that is coconut, copra, rice, noodles, and turmerics out of Solomon Islands. Currently at Singapore with Nectar, which is a growing company with more than $100 million project cost covering Singapore. PNG, Leh, and Indonesia to process more than 32,100 million tons per annum of cocoa and 20,000, if I'm correct, kg per day in bulk of chocolates. Yeah, that's nice. And he has a lot of awards and achievements. He is a promoter director of Nectar Holdings, which is an integrated dairy and food company with emphasis on cocoa processing, chocolates, organic food, and supplements with strong emphasis on nutraceuticals, if I may pronounce correct, and containerization. Past executive director, operation in Concord, Container Corporation of India, first company in infrastructure in private mode and private public mode, presently a Navaratna company. He is committed to ensure percolation of profits. I think these are the core strengths, profits to the primary producers who get less than the GST of the final product through creative financing and innovative supply chain solution in storage and fermentation. Very impressive profile, sir. So we welcome you for this Monday musings. And I'll take the privilege to again reintroduce CA Ramji to this forum. He's a chartered accountant, practicing for over 38 years. He specializes in consulting work like introduction of contemporary cost management, apart from practicing in areas of taxation, both direct and indirect, and company audits. That's why he selected that topic today. And he also got a lot of accolades and awards. And he's a past chairman of Institute of Chartered Accountants of India, Coimbatore chapter, and past president of the Auditors Association of South India, an 84 years old organization. Past chairman of Indirect Taxes Subcommittee of Indian Chamber of Commerce and Industry, Coimbatore, apart from being a special invitee to the Governing Council. He is a past treasurer of Coimbatore Management Association. He is a current managing committee member. Visiting professor for various business schools, including Janssen School of Business, Parjar School of Business Management, PhD Institute of Management, etc. Recipient of the Ravi Praskar Award for the best trainer in India by the Indian Junior Chamber at their national convention held in Bangalore during 1994. Speaker in various topics and organization. His life partner, Meena Ramji, also is a cost accountant and is blessed with two daughters. I think with this introduction, again, I am welcoming you all for this very interesting forum because we are going to gain out of two speakers today. Without much ado, Ramji, please take over.
Thank you, Dr. Ravindran, and welcome, Mr. Soumya Mahapatra. Gives me a great pleasure to address or to be a part of this Monday Musing after a long time. There has been a gap since I have addressed the Monday Musing program. I am sure the Monday Musing has been every week, unfailingly, it has been bringing in very good speakers. So, and the audience is also benefited by their knowledge and expertise. Today we are going to have Professor Soumya Mahapatra, who is expert on foreign exchange and currency transactions. He is involved in the export and import areas. Dollar and various currencies. If you look at today's scenario, you'll find that a lot of challenges facing India in terms of the global, its presence in the global economy. There's a lot of issues which are being faced by various countries based on, there has been anything happens in the world, every country gets affected. So we are also having, so we are amidst such confusion and we do not know what would be the trend in terms of how the currencies across the world are going to react or behave. So today we have Mr. Soumya Mahapatra, who is going to take us through this complicated web of a topic, in fact, I should say. And he's going to information which he has got. And I'm sure at the end of this session, all of us will be much benefited by getting an insight into this international currency world. So with these few words, I request Mr. Soumya Mahapatra to take over and lead us through this very important topic. Thank you. I shall come back after his lecture is over. Thank you.
Thank you, everybody. And thank you, Mr. Ramji, as well as the Honorable Secretary. Well, I have the privilege of being associated with the business community for 20 years now and more. So that has given me a practical thrust to all my intellectual forays that I did in the first part of my career, including a stint in the civil services for about 20 years from 1984 batch. And I have come to a position where I feel that there is one can learn as much from theory as from practice, as much or more. In fact, one of my critiques of the entire policy making has been that we have demonized practical managers for a long, long time. The topic of my discussion today is centered around what I consider to be a reset that is happening after nearly 50 years of continuous growth. I am an observer of human nature and history too, and I align it closely with government policy. I have noticed since some time now that there are progression of events that has got my attention fixed. And these acceleration of events from 2017 to 2022 is leading us to what I call a great reset. What is a reset? What has happened objectively is that what we notice today is that assets are being blown to ridiculously high proportion by crazy monetary policy, where more money has been created in the last 3 years than the last 50 to 70 years, and where interest rates are absurdly low. When I look at expectations in India and abroad, it is quite ridiculous when I see homeowners are expecting to double value every 3, 4 years, and price discovery becomes impossible. Crypto equity portfolios are up insanely. So we have to go back in history and analyze what actually was the structure of the given monetary policy and what we have now evolved to, which is leading to this so-called asset bubbles. And what corrections can we expect? What stresses will build into the system? And how is India going to be affected? And where will be India's position in it? So we are dealing with a period where it is extremely difficult to know what is the fair value of an asset. Let us go back in history. At the end of the Second World War, specifically 1944, at the Bretton Woods Agreement, the USA was anointed that the USD would be guaranteed at the rate of $35 per ounce of gold. That has made the US dollar the reserve currency of the world, freely exchangeable to gold at that rate. However, around 1970s, it was no longer viable as gold reserves drained away. Instead, dollar became pure fiat currency. It was decoupled from any physical store of value until the petrodollar agreement was scripted by Kissinger in Saudi Arabia, which guaranteed national security in exchange of dollar being the sole oil currency. For nominating the dollar as the sole currency for the oil producing OPEC in 1973, the character of the USD was changed from a gold-pegged currency to one which ran on fiat, the fiat which is monetary policy. A secondary feature of this agreement was the purchase of US debt securities with surplus oil receipts. By 1975, all OPEC agreed to price oil supplies exclusively in USD. So what has happened basically is that there is a huge synthetic demand for a currency that is no longer pegged to any real asset. Let us go back to 2017, 18, 19, 20, 21. In 2017, the Bundestag, the German bank, recalled 70 tons of its gold from the US. It said, we want to get our gold back. It was 70 tons. And they had to fight for 6 months with a very unsavory kind of relationship to get this gold back. They got the gold back. And what subsequently followed was that Poland, Holland, Norway, Yugoslavia, Turkey, and then China, and a host of countries, nearly 40 countries, started buying this gold. they were all buying the gold back. So they bought back more gold than 60 previous years. So for hell, they knew why they were buying back. Maybe we didn't know about it, but every central bank has been buying gold since 2017. So what provoked this kind of movement? And unlike another event of great proportion was that in 2019, the Bank of International Settlement decided to classify gold as a high-quality international asset. Based on Basel III rules, it allowed gold to be classified as a high-quality asset on par with cash. So Austria, Czechoslovakia, Poland, Turkey, Germany, Norway, Holland, India, China, all of them bought gold from the open market. And also they started hoarding the gold. Then you see the Belt and Road Initiative of China. What was it done? It was the greatest infrastructure project in history to link up the continents. And what was the mode of settlement between the partners? The mode of settlement between the Belt and Road partners was the yuan, the Chinese yuan. And for the first time, the yuan got linked to the Shanghai Metal Exchange, and it could be redeemed in gold. So we had a bilateral trade grouping which could redeem their outstandings through a gold-pegged currency, which was yuan. That was a fundamental shift. Then came, please notice this very, very important fact. Then came the war with Afghanistan and the withdrawal of the US from Afghanistan. That signaled to the world that the US was no longer a reliable security provider. And pronto, the next day, the Saudis announced that they had signed up with Russia for protection and security. So look at the change. Kissinger in 1973 guaranteed security in exchange of the petrodollar being pegged to the US dollar and the reserve currency. And in 2019, Saudi Arabia decided to sign up with Russia for a security arrangement. So this was the beginning of the end of the petrodollar regime. And worse was to follow. What happened after that was the so-called Ukrainian war. Because the moment we started the Ukrainian war, we had this great banning of the Russian currency from the SWIFT system and the trading system of the world. So the idea was to weaponize the reserve currency of the world to get political changes in the system. Nothing that was the original intention. So following this, the rest of the world has realized that who is next? We could be next. It could be Nigeria. It could be India. It could be Russia today. It could be Indonesia tomorrow. So much of this perception has led to formation of more bilateral blocs like the Shanghai Initiative, which linked the Eurasian currencies, Eurasian nation. Now I hear that the Eurasian nations, the Shanghai understanding, is coming up with its own digital currency, pegged to individual currencies of the region. That is Belarus, Uzbekistan, Tajikistan. So the world is moving from fiat towards more trading reserve on linked to actual commodities, of which gold is the main standard commodity, which is being pegged to. So the initiative is towards a movement away from fiat currency towards a pegged currency back, because people wanted a real currency of value, which was originally in Bretton Woods envisaged. Come forward a little more. In August this year, the BRICS nations are meeting in South Africa in August. And what is the primary agenda? To have a BRICS digital currency. And you know how many countries are waiting for admission to BRICS? It is headed by Saudi Arabia and Brazil, of course, and 33 nations are in the pipeline to become members of the BRIC and to have the BRIC digital currency in place. So unquestionably, what we are seeing is today, about 3/4 of 80% of humanity residing in all the major manufacturing and producing countries have decided that the dollar is of little value and it is provoking hyperinflation of assets, and it is making life and these countries more poor, because they have realized that it can be weaponized by the US at any point of time. So today we are seeing the beginning of what is popularly called de-dollarization and the movement towards a digital currency, of which gold is a peg. India has been buying, it's the second highest purchaser of gold last 3 years. Turkey has bought a lot of gold. And then Russia has demanded, then in lieu of the London Metal Exchange, we should have the Russian Metal Exchange for gold, the Russian standard. So what is being witnessed is a movement back to dollar, away from the dollar as the reserve currency towards something which is based on real commodities. Now, real commodities like, say, corn or copper are very difficult to find a fair value as a currency. But today, most of this currency in digital form will have to conform to primarily gold. So the buying of gold by the different banks, which is unprecedented over the last 60, 70 years, more gold has been bought in the last 3 years. And today the gold is touching close to $1,900 to $2,000, up from $900. So what would be the likely outcome of this? Because it covers 3/4 of purchasing countries, 3/4 of humanity. So will the US sit back and watch? I would say at the moment, the US is not been invited to be participant in any of these blocks. And there's a reason, because this kind of movement is also synonymous with the falling value of the dollar. The US Treasury bill, if you factor real inflation, which is at 6.42% today in the US, but this is artificial because they have taken out the housing prices from that index. It should be actually 15. Even if you take 6.5 for a 10-year yield, the US securities is negative by 3.5%. So most of the countries are looking to move to something more concrete, viable, and valuable and of fair value. So what is this going to create? This is going to create a huge inflationary tsunami in the West. All the assets are inversely related to interest rates. And as the dollar's demand keeps going down and the value of the other digital currencies keep going up and more transactions are nominated, it will be reset for the first time in 80 years. The US dollar, which controls nearly 59% of the world as a reserve currency, and the euro another 20%. I expect by 2023, beginning of 2024, it will come down to 25 to 30%. Who will be the allies of the US? Canada, Australia, Japan. And where is the rest of the world? Including Latin America, Argentina will be with the BRICS currency, or they will be with the Shanghai, or they will do bilateral trades and yuan. The Shanghai Cooperation Organization, it comprises 60% of land area in the world and pan-Asian trade settlement. And 35% of world GDP is in this Shanghai bloc. So gold will be the foundation of a new system. And Saudi Arabia and the BRICS world and India have all declared readiness for settling in different currencies. So when the inflationary spiral will hit the West, what will happen? The three traditional pillars of the West, of the wealth in the West, are stocks, bonds, and real estate. Stocks have risen with no relation to the PE or the earnings. They've gone up by 300%. So they went down by 13%, then they corrected by 6%, and up again by 12%. But these are artificial movements. And that is why you're seeing this you saw the great boom and bust periods of the so-called tech, followed by housing. And today the bust is on all sectors, housing, tech. And therefore you're seeing the great layoffs in the tech sector as people don't have access to easy finance anymore. Inflation has gone to about 6 to 9% presently in the US. In Europe, it is 12 to 14%. It's very easy to say Putin is the reason for that. But Putin is only an element of that reason. The major reason is the printing of notes in the United States. The so-called, they have a policy of what is called, they have credit enhancement and credit notes, and the printing of currency, the easement policy, the so-called easement policy of Q1, Q2, Q3, and now before the elections, they'll again ease. But the interest rates, which have been abnormally low for the last 50, 60 years, will no longer be aligned. So as interest rates goes up, I see real wealth being diminished across all these sectors. So what are the threats to this emerging movement, to the so-called reset? I see three kinds of threats. One, there could be differences within the BRIC countries. That could be India and China having differences, but I don't see it happening enough. I don't think it overrides. I don't think it will override the movement towards de-dollarization. Then comes the second important way. What will happen to the gold? The gold is being produced at 1% every year extra. But the demand and average growth rate in the world is 3.4 to 5%. So it will not be able to satisfy the need for a currency based on gold. So I see, and this is my perspective, it's entirely different from what I see, that every central bank is going to have a digital currency. If there's a digital currency, and today 66 countries are in the final lap of introducing their own currency in digital form. So if their currency comes in digital form, there goes every little investment, every citizen's liberty will be monitored by the central bank. Every little transaction can be tracked. But this is inevitable because the way politicians and bureaucrats run government, because they've never run businesses, they will like to have a very tight control over this digital currency. But I see, on the contrary, if there is not enough gold, I see that Bitcoin, which cannot be printed at will, which cannot be replicated, will be a huge asset favorite. It looks like it is testing 16,000. It will probably go down to 9,000. And then it will climb steadily because people are looking for value now. There is nothing to back up. Dogecoin had 80 billion market transactions, but its net worth was nothing. But as a value term, the currency will grow. I saw Bitcoin coming. What will be America's reaction? I think America is not going to take it easy. The US, at some stage or other, will have to convert its currency to a digital one based on its gold reserves. It has roughly 8,100 tons of gold. China has got declared 6,000 tons, maybe undeclared because they are buying from the year 2012. They may be having close to 10,000 tons. India has got a formidable amount of gold now. Over the years, maybe 4,000 tons. Not the private gold, which we're importing at about 1,900 tons every year. But for India, I think, I think the best days are yet to come because our demography is so positive. China is going to reset its population from 1.4 billion to 770 million in the next 5 years. Not enough people to produce wealth. And it's only as life expectancy goes up and as more people join the productive age, you'll have real growth. So I see in the balance of interest, India will be the new superpower 100% over the next 5 to 7 years. I'm very positive, provided we manage the politics. So I see that the weaponizing of the dollar as a reserve currency has alarmed the world sufficiently to move towards a great reset. There'll be a huge inflation in the West. It's already being noticed. They have printed close to 31 trillion currency over the last 2 to 3 years. And the total debt of America today is about 131 trillion that can never be serviced. That consists of pension funds and the homestay funds, the retirees funds, and the commitments to security and things like that. 131 trillion can never be serviced. And I don't think it's going to be unipolar to any extent. So we can expect a lowering of the inflationary spiral with oil and other commodities as the reset takes place in the local currency, and the urge to accumulate dollars will not be there. And this will lead to what I conceivably think is the Great Reset. It took 50 years to dethrone the pound sterling, and I think the time has come in 2023 that we will see a confluence of digital currencies being pegged to the gold in some fashion or other, or to real commodities, if the algorithm can be found for the various commodities to peg it. That's a challenge, but we are surely and definitely moving towards this. Thank you. Thank you very much. I'm open to any questions. I've got substantial facts to illustrate. I didn't make a presentation with slides because these are all common facts which you can check anywhere. And being an observer of history and pure monetary policy, I feel that the root cause of all this is the fact that monetary policy has taken over the strategic currency settlements of the world. So everybody is looking for Fed's announcement of interest rates. Every year we think it's a very important announcement. But look carefully and you'll see the underlying movement away from the dollar towards more bilateral trades. India has got a very clear strategy. They say we don't want to join any multilateral grouping. We will just be a partner in bilaterally with the UAE, maybe on rupee trade, with China on yuan or rupee, with Russia on rupee. So India is on the right track, absolutely. And I see that this reset will come earlier than most, and there will be real denudation of wealth in the West because of the inflationary spiral, which will render purchasing power. It will bring down the purchasing power of the dollar to a huge extent. And I don't see much correction because there's an election coming up in 2024. And all the countries are moving towards a very strategic reset and going towards digitalization of currencies, pegged to possibly gold for the first half and other commodities. Thank you very much. And I hope I didn't speak too fast and too much. But this is, of course, this is allied to various other concerns, which I have got another paper, which I'm writing now. But this is the clear trend.
Thank you, sir. Mr. Kumar, any questions?
One question, sir. Where do you see the dollar to yuan currency in the next 5 years?
I think people expect that the war with Taiwan will happen, but I think the Chinese are very practical. They will not move because they don't want their markets in the G10, 20 to go away, because they're a producing country, manufacturing country. Number one, you must understand that the pandemic has hit us more badly than anything else, because anything that has to do with commutation and transport, like real estate, there are 42 million units vacant in China, and the population is going to be up to 70 million, 700 million. So you're going to have no demand for housing. So their easement policy will go down. I see China will have major difficulties because as its growth slips, but the yuan being traded already successfully tied to the London exchange with gold has its own value. And that's why the Trade and Belt Road Initiative, it has linked many countries. It's got its potential evils, it's got its politics, but it is trade with some real commodities. Nobody wants to invest in US securities which are giving a negative return. You want to have future value of your earnings. You are the producing country. You are the consuming country. You can't barter away.
Shall we then move to the next session? I think the time is
Yeah,
sorry.
Yeah.
Thank you very much, sir. I think we have a lot of questions, but I think we'll possibly have to send it to you and then get back.
No, no, no. You can after Mr. Ramji's finished his budget analysis, which is
Yeah.
more
Yeah.
influential for all of you being practitioners. Well, I'm not aligned to that. I'm actually a practitioner in this field, and I'm doing a lot of work on this area.
Okay. So
Wonderful.
Thank you.
So can we move from the foreign currencies to the impact of the budget? Talk by Mr. Ramji, please.
I will share my screen now.
Okay, wonderful.
Is it visible?
No, so not yet. Yeah, I'm able to see, but then you'll have to click it and then go inside.
Now, agenda is visible.
No,
No, sir, you'll have to double click on the file.
the budget analysis, you have to double click on the file.
Yeah, I did that. 1 minute. I'll again do that.
Ah.
Huh? It's coming now.
Sir,
Not
where
yet.
is screen கீழ வரும் sir. அங்க போய் click பண்ணுங்க. It
Inga?
would have gone on to another screen.
Huh?
The file would have opened on another window, sir. You have to go to that window and click on it.
Varda? Is it coming?
இல்ல sir. Sir, கீழ பாருங்க sir. கீழ menu barல இருக்கும்.
கீழே இன்னொரு window open ஆயிருக்கான்னு பாருங்க.
Menu barல ஒன்னும் ஓபன் ஆகலையே. வரலையா?
இல்ல சார், இன்னும் வரல.
Oh. What do
You're
I
able to
do?
see that. You come to that file. It's sharing. The screen is being shared, but you've not gone to that particular file.
Top share போட்டு பண்ணுமா? New share போடணுமா?
No, just try to, I think, double click on it and find out whether it's open somewhere else below. Now it's come.
Yeah, now it's come.
Budget cookies take some time to reach the common man, so it's no problem, sir.
So today we have got this is the agenda for the discussion today under the direct taxes. Come February 1st every year, we find that budget is becoming a very big event in the parliament, where the finance minister, after a hectic 3 to 4 months of confabulations with the revenue secretary and various other bureaucrats, and then after having the halwa, the as a compensation for the hard work they have done, the finance minister comes to the parliament and she presents the budget. So today I thought I will not go through the entire budget in the way it has been done, but I'm just taking bits and pieces from various places so that we'll have some logical presentation of topics, so that people can really identify themselves with those topics. So the first one is the rates of tax, salary, business income. So what are the changes? Capital gains, income from other sources, international taxation, losses, Chapter 68 deduction, and then the TDS provisions, refunds, cash loans and repayments, charitable trust. So many topics are there, but the number of provisions are quite less. So you don't have to worry why so many topics and how we are going to cover. So as far as the rate of taxes is concerned, there is no change basically there is no change in the rate of tax, excepting for the 2 regimes which they have now brought in. Earlier it has been there for the last 2-3 years. So now by default, the new regime rates will be on the surface. If you want to choose the old regime, which means you have the 80 section, Chapter 6A or the 80 deductions and all that, if you want to opt for that, then you will have to opt specifically for that. Otherwise, default is the new regime. So the old regime It's optional for individual and HUF. No change in rates for 24-25 and rates of surcharge. Then the new tax regime, there is a significant change here. The income below, they have extended the income exemption limits to 7 lakhs. So which is becoming a very big news. It gained a lot of publicity in during the post-budget analysis, where the total income, if it exceeds 7 lakhs only, you have to pay tax. The only catch here is that if you exercise the new regime, new tax regime, then you can take benefit from the lower rates of tax. For example, the slabs of tax has been reduced from 6 to 5. Surcharge has been reduced, maximum surcharge has been reduced from 37 to 25%. The rebate under Section 87A has been increased to 25,000 from 12,500. Earlier it was 12,500. And then you have income between 10 to 15 lakhs, reduction in rate of tax from 30 to 20. For salaried individuals under the new tax regime, standard deduction of 50,000 is eligible. In addition, profession tax of 2,500, and then deduction in case of standard deduction for family pension, which comes under income from other sources, 15,000 rupees has been given. Deduction with respect to contributions, amount contributed to Agniveer Corpus Fund has now been given, especially where government gives the grant to the Agniveers. Those amounts are not treated as taxable income. So this is the general rate of tax which has been, where for individuals, new regime, you can see the rates of tax have been changed. Rates of tax from old regime to new regime. I think the screen. Are you able to see the rates?
Yeah.
Visible, sir.
Yeah. So the rates have changed from 22 lakhs to where it has not been opted. 5% up to 5 lakhs, 5 to 10 lakhs, 20%, above 10 lakhs, 30%. Whereas those who are opted for the new regime, the taxations have been basic exemption 3 lakhs, then you have 3 to 6 is 5%. So in effect, there's a good reduction in the tax rates. Only thing is the savings incentives have been removed. So these are some of the surcharge rates which have come. I will just skip all this because of time constraint. We go straight to the salary. So here under salaries, there are two major changes. One is the rent-free accommodation under 17(2). Effective from 24-25, it has to be computed in the prescribed manner. They'll give us the rules. Then the accommodation shall be deemed to have been provided at a concessional rate if the value of the accommodation computed exceeds the rent recoverable or paid. That's a major change. So in case the company gives provides a rent-free accommodation to the employee, then the amount of tax shall be, it should be, if the value of the accommodation exceeds rent recoverable or payable, then that will be the amount which will be charged as a perquisite. Then standard deduction, and then Section 87A, this we already discussed, standard deduction 50,000 under the new regime, and for family pension up to 15,000. And in respect of the rebate under 87A, where the income, this is the old scheme, where the income does not exceed 5 lakhs, deduction of 100% of income tax or 12,500 shall continue to be available. Under the new regime, that has been extended to 25,000. Up to, if the income does not exceed 7 lakhs, then you have a higher rate of rebate. So applicable from 24-25. Under profits and gains of business, we have Section 28(4), Clause 11 of the budget, where this is to tax the value of benefit, whether convertible into money or not, arising from business or exercise of profession. Here, this covers the payments made to doctors, the samples, and then they give the overseas tour is sponsored by companies for doctors, or the benefits in kind are given, samples are given, which may later on be sold to patients. All these are now taxable as a perquisite or benefit. And this will be taxable as a TDS under 194R, and it has to be paid before the payment in cash or kind is given to the doctors. Here only one important thing is the TDS at 10% is provided for a payment which is more than 20,000 rupees, and TDS has to be deducted before the making the payment. Is not applicable if the person who gives such benefit is having a turnover below 1 crore for business or 50 lakhs for profession. The department can initiate prosecution under 276B in case TDS is not deducted before releasing the amount. We have one on preliminary expenses which says that earlier it has to be approved by the board, and now you have to only furnish your own self-certified this thing about preliminary expenses on various areas where you have spent. So this is a good scheme actually. The next is 43B, where the budget seeks to insert a new clause H in 43B, which talks about payments to micro and small enterprises beyond specified time window. The problem is this MSME, most of the people who are vendors to large corporates, they don't have a, they don't have a power to dictate terms. So the large vendors take advantage of such small vendors and they delay their payments, leading to a working capital constraint in the hands of the MSME. So as per this 43B, if the payment is delayed beyond 45 days, if there is a written agreement, then the amount shall be disallowed in the hands of the large vendor who actually is a purchaser, and 15 days in other cases. So if you have a written agreement, you got 45 days. If you don't have a written agreement, you have to pay within 15 days. Now, who is a micro and small enterprise? One whose investment is 1 crore and a turnover of 5 crore is called a micro enterprise. Small is investment of 10 crore and turnover of 50 crore. Now, what happens if they are not registered under micro? It's something, the budget talks about the vendors who are registered under MSME Act. Whereas if they are not registered, what happens to them? Something which has not been clear. Presumptive taxation, tax audit, I will skip this because it's more to related to the professionals. For audit professionals, only thing is here the limits for here, and this is relevant for any business associate up to turnover of 1 crore, no tax audit. Between 1 and 2 crores, where the income is more than 6 to 8%, no tax audit, even if more than 5% cash receipts. But if it is more than 2 to 3 crores, income more than 6 to 8%, no tax audit if the cash receipt is equal to less than 5% of the aggregate turnover of gross receipts. And in the other last case, 3 to 10 crores, no tax audit if cash receipts and payments equal to or less than 5% of the aggregate turnover of gross receipts. So this is very important. Now, for professionals, wherever they declare, under this scheme, 44 ADA, one has to be careful because you have to pay tax on 50% of your gross income. So that is deemed to be the income and on which the tax has to. That does not change. Okay. Next. Professional assessee, this I will read, 50% or more, even if the cash receipts are more than 5%. Then we come to a very important chapter called capitals. Now, here we talk about clauses, section 242A, which has defined what is an electronic gold receipt, and section 47 and 49, clause 3, 21 and 23 of the budget. Now, wherever there is, now this is exactly what it is coming in the manner in which Mr. Soumya was talking about. This budget provision is introduced just to enable government to capture all the gold which is floating around. Otherwise, which is not, which is kept in the lockers. So here they have given a very important provision which says wherever you have deposit of gold involved, and if that gold is exchanged for electronic gold receipt, then that conversion of gold into EGR or after a certain time EGR to gold is not to be considered as a capital asset. So therefore, there is no capital gains. No tax on capital gains and interest income. So EGR earns some income, interest income, which is about 3% without tax. So that 3% income will be tax free, but you cannot set off losses. So the very important scheme, which is running towards the, or which is our government is moving towards treating gold as a reserve currency. Then we have capital gains under 45(5)(a), which talks about current capital gains, which are on the stamp duty value of the assessee's share of completion wherever there is a joint development agreement. Then the capital gains is based on the assessee's share of the project. Suppose you have got a 10-cent land on which he has given it to a joint development agreement for a joint developer, and he gets about 2 flats in return for the land which he has spared. Then tax shall be, capital gain shall be computed on the stamp duty value of the assessee's share of that 2 flats. Okay, and as increased by consideration received in cash. It was the consideration received in kind was silent. So therefore, this amendment has come where the fair value shall include the the stamp duty value shall include the consideration plus the cash as well as consideration in kind. This amendment is prospective from 23-24. We have another important amendment which talks about 54, section 54, 54F, clause 25 and clause 30. Here, wherever the any purchase within 1 year or sale or any property which is purchased within 1 year of sale of another property or a residential property or constructed within 2 years of sale, such purchase or construction can be claimed as a exempt from capital gains, provided you have invested the entire amount of capital gains in the property. Now, this was a scheme where large properties, say 100 crore, 200 crore properties, were being purchased and were being sold, and 150 crore purchase was made. So that thereby, or equal amount of purchase was made, thereby no capital gains was attracted because everything was long-term capital. Now they have limited this reinvestment to 10 crores. So any capital gain, however be the volume or amount of transaction, value, whatever be the value, your capital gains, say on 100 crore asset, the maximum amount you can be eligible is only 10 crores. Your cost was 80 crores, your sale value was 100 crores, you got a capital gain of 20 crores, and that has been reinvested, you will get only 10 crores. And if it has been reinvested, lesser amount has been invested, then you will get a proportionate exemption. So that is what it says. And consequently, suppose you have not been able to invest in a property and you have gone and deposited the same in a capital gains account scheme, then all these amendments will also applicable to the capital gains account scheme, which means you cannot get a benefit more than 10 crores even if you invest in a capital gains account scheme. Now, traditionally, there were 3 conditions, during our CA days, when we read. There were 3 conditions which were normally seen while looking at a capital gain. One, it should be a capital asset as defined in section 240, 2 subsection 40. There should be a transfer of a capital asset for consideration. There should be a cost of acquisition. Now, where there is no cost of acquisition, Supreme Court in Srinivasa Setty's case said that it cannot be a capital gain. It cannot be a capital gain because there is no cost, and therefore it is not subject to capital gains. In order to overcome this decision, the amendment is now being proposed, which says that wherever there is a intangible asset or any rights which doesn't have a cost, or which the cost is nil, then even in such cases, the capital gains will be leviable based on the value of the business or whatever value ascribed, for example, goodwill has been created or something, that minus nil, that amount will be the capital gain on which tax has to be paid. So this is a, this is a antidote to this BC Srinivasa Setty's case. Okay. The amendment is to widen the scope. Another problem is wherever there is a right or extinguishment of a right. For example, you may have taken a shop on a, you would have stayed there for more than 10 years, and then somebody gives you a compensation money for which there was no cost. Then such compensation money will also come under this, squarely come under this, because the section, the amendment says, or any other right. So this will be an extension or extinguishment of a right, may also be subject to capital gains. The only thing is we don't know whether it will be retrospective or prospective. So they have only said 24, 25. We need to see how, whether they will apply this for the backlog of cases. No double deduction for interest under 48(2). Wherever interest has been paid on acquisition of a house property, we were including it under section 24 and also under section 80C. So now there is no double deduction. So therefore, you can only claim it in one place. Income from other sources, receipt on issue of shares, wherever there is a receipt by company of any share consideration for issue of shares that exceeds the fair market of shares from any person, including a non-resident, shall be taxed under income from other sources. Which means, suppose a company sells its share and the consideration exceeds the fair market value of the share, then the difference will be subject to tax in the hands of the company. Now this I will skip because now this is very important. 56(2), which talks about insurance policy, receipt of money on insurance policy. So here you may have a policy which you may have taken. Of course, this is for policies issued after 1/4/23. So if such policies mature, then only where, I mean, the total of the exemption of such policies will be available for those policies which do not exceed 5 lakhs of rupees. So one has to be careful in planning the investment as well as in accounting for the receipt after the maturity of the policy. Only thing is the proceeds on death from that policy will be exempt from tax. Now here in the case of international taxation, income deemed to accrue or arise in India. Now 56(2)(10) actually is a income from other sources section, wherein any sum exceeding 50,000 paid to a non-resident by a resident will be deemed to be income accrued or deemed to accrue in India, and hence it is taxable. Now this amendment is now there was a claim that if the money is paid by a resident to apart from resident, not ordinary resident, which means those who satisfy the provisions of section 9. I'll not go in depth into that. Then we talk about profits and gains of civil construction. Here, the providing incentive to the foreign construction companies which are erecting plant and machinery or testing or commissioning with in respect of turnkey projects. Income is presumed to be 10% of the amount paid or paid. Maintenance of TP records, transfer pricing records, which is not very relevant to most of us here. Limitation on introduction also we skip. Then we come to losses. Here, wherever there is a carry forward or losses for strategic investments. Now, the permission to carry forward loss in case of change in voting power to strategic investment, here it has been extended. It is meant for wherever sale to a company, if the investment results in the disinvestment results in reduction of shareholding below 51% and transfer of control to the buyer, still the carry forward of losses will be allowed. And in another case, wherever a startup is there and the startup is allowed, earlier they said only it will be a set off or carry forward will be allowed up to 7 years from the date of incorporation, provided these shareholders are not less than 51%. The amendment has been made to increase the period of set off of losses from 7 to 10 years from the date of incorporation. Then we come to chapter 6A deduction. Actually, that ATC and all that, wherever there is a new regime, those are all not applicable. So none of the chapter 6A deduction will be applicable for a new regime, only for old regime. So we need to see how long it will be continuing. 80CCH is actually deduction for contribution to Agnipath scheme, the new scheme which will enable youngsters to join the army. They have set 5 years. So for 5 years, they'll be paid money. Wherever the salary includes the contribution made by central government in the previous year to Agniveer Corpus Fund. So the individual who is enrolled in the Agniveer scheme, Agnipath scheme, and who has subscribed to the Agniveer Corpus Fund, he shall be eligible to claim deduction of the same in the computation of the income of the previous year. And where central government makes the contribution, then such contribution shall also be exempt under section 10(12)(c). Now we come to section 80G. Specifically, 3 funds have been removed from the donation list: Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Trust, Rajiv Gandhi Foundation, because there was a raid and they have also not been given continuation of registration. So all these are because of that. Deduction for donations to certain funds. Wherever provisionally registered approved trust or institutions, it can apply again for regularization at least 6 months prior to the expiry of the period, or within 6 months of the commencement of activity, whichever is earlier. Any registration given is valid for 5 years. This we have seen. Rebate we have also seen. Then we come to TDS provisions. TDS on payment of accumulated balance due to an EPFs. Amendment to omit requirement. So wherever PAN was not there, the deduction of tax was higher. Now that has been omitted. TDS on interest on securities. TDS on interest to a resident on securities issued by a company is to be deducted at 10%. Now the exemption which has been withdrawn is under proviso 9. Dematerialized listed securities and debentures have been. So this will skip. New scheme. Okay. Cash withdrawals from bank. Now this is again for corporate. For individuals, TDS at 2% of aggregate withdrawals where it exceeds 1 crore. And for cooperative society, they have relaxed the limit to 3 crores. 5% for non-filers. That's very important. Wherever there is non-tax filers, and if they withdraw money is exceeding 1 crore, the TDS will be at 5%. TDS on benefit, which I talked about in 194R under section 28(4). This is at 10%, which will be including cash or partly in cash and partly. And this has to be paid before the payment of such a benefit or tax. We'll skip this. We'll skip this. Non-filers of income tax persons are not required to file return of income. There are specified persons who may be declared as they need not file return of income. So they will not be included in the category of non-filers. So the amendment has been made in respect of specified person. TDS on remittances in case of overseas package. Now this is a very important thing, for those who have their children or who have their relatives abroad, and in case you want to send any remittance. Here the TCS rate on remittance overseas to package, and for purposes other than education, medical treatment without any threshold. So in any case, you have to the banks will deduct TCS at 20%. You can of course claim it in your return. Removal of 7 lakhs for remittance for any other purpose other than education. Then maintain TCS at 5% and threshold limit of 7 lakhs for education and medical treatment. So up to 7 lakhs, the threshold limit of 5%, TCS of 5% is still continuing. So this I will skip. Refund, interest on refund. Only problem with refund is actually they were to pay 6% interest on the refunds. That is per annum, 5.5% per month. What they have done is they have allowed the officer to withhold the refunds if he finds that an assessee has got subsequent assessments pending. Now the problem is these are is against the assessee actually. So, but then this right has been given so that the government can reduce its working capital requirement. Now, only thing is the substitution of section 245, which is now it says power to adjust any refund after an intimation in writing, and power to withhold a refund is up to the principal commissioner of income tax or commissioner up to the date of order. Cash loans and refunds, amendments, repayments. Amendment for increasing the threshold limit for 20,000 to 2 lakhs under 269 SS and 269T. And it is a parity with the banks. Now, charitable trusts, there's a lot of amendments have been brought in. For a trust, now things have become difficult. So, if by any chance your trust is not renewed before the due date, then there will be an exit tax imposed on such a trust on the whole of the value of the property. Another problem is in case there is an application which has been made, but the commissioner has not applied, then it's also to be deemed to be a case where this exit tax can be. So as a trust, one should be very careful. A lot of specified violation is talking about that additional exit tax. Okay, so we'll skip all that. Then we come to the indirect tax because of time constraint. I'm skipping. Few provisions are there under indirect tax. Varda, is it coming? Again, same problem, huh?
Your double click, yeah.
Yes, sir.
Click. I've done the double click.
No.
I should go to share screen, huh?
No, screen is shared already, sir.
But why is it not coming?
Sir, double click it again, sir.
No?
No.
Yes, sir.
I will come from. Double click only I have done. Presentation. New share.
Yeah, now it's open.
Okay. Now, there are few amendments in the indirect tax which we will go through. One is registration, amendment in registration under section 23. This registration where the supplier supplies exempt goods exclusively, whether he has to take a registration under GST. This has been answered by the amendment whereby under amended section 23 is not mandatory, subject to such conditions as may be prescribed. So we are expecting some circular on this. ITC reversal, wherever the scope of exempted supply expanded to include supply of warehouse goods before clearance for home consumption by amendment of section 73. So in case of reversal, the transactions value of exempted supply will exclude the transaction covered under schedule 3. input tax credit to be paid in case of non-payment of supplier to the supplier, where the supplier has not been paid, just like that MSME. Value of the has not been paid value of supply along with the principal for a period of 180 days from the date of invoice. An amount equal to ITC avail shall be paid by the supplier along with the interest. So this is now in alignment with the return process under Rule 37, but the ITC can be claimed subsequently on actual payment. We talk about composition levy suppliers through e-commerce portal. So under earlier provision, no person under e-commerce under composition levy was allowed to supply goods through e-commerce portal. Now they have the proposal allows such a supply, provided the e-commerce operator is required to collect tax at source under section 52. So penalty is also there in case he doesn't do it. In case of CSR expenses under GST, it was not blocked credit, and whereas under income tax it was a blocked, it was disallowed expense. So in order to have a alignment with the Income Tax Act, they have amended the CSR expenses. ITC on CSR expenses is now blocked. And in case of returns, GST returns, generally we know that GSTR1 has to be filed on or before 11th of next month, being extended to 3 years from the due date of filing returns. But only thing is, you have to file the earliest return before filing the return for current period. This has been made. So the 3 years has been brought. Beyond that, you cannot do. Same thing with 3B, same thing with 9, 9A, 9B annual returns. So it has all been extended by 3 years. Compounding of offences are now allowed. So some of the offences which are earlier, led to arrest and all that has now been brought under compounding, provided it is done once in a lifetime. Wherever there is a transport of goods, the place of service in case of transport of goods outside India, that has been now defined. It says in case of registered person, location of such person. So if you are exporting the goods, then the place of supply shall be your location. In case of person other than a registered person, location where the goods are handed over for transportation. So I think with these slides, our discussion on both direct and indirect taxes comes to an end. I thank you all for a patient listening. And in case of any questions, I am willing to take it. Thank you. I thought it will be a long session. Luckily, I was able to compress so that it comes within the reasonable time. 7:53. Good. Any questions on the budget?
I think anybody having questions can ask. I know it was a very fast presentation. I mean, Mr. Ramji almost had to go like a marathon runner, going so fast with so many things to be discussed. But anyway, I think it is all we have to look at another day when he can discuss in detail. But if there are questions, we'd like to take it across now. So shall I start with the question, sir?
Yeah.
Do you think with so many benefits being given to the new tax regime, the old regime will be put to an end in the next couple of years as we see it?
That should be the logical conclusion. Yeah, it's the beginning of the end. Old regime will eventually be removed. For political reasons, they have kept it. After the general election of 2024, I am expecting that to be removed. So no deductions for savings. They want us to consume, be a consumption economy than a savings economy.
That is good news for many of our young people in the audience. Spend more, the government wants you to spend and not save necessarily.
Yes.
Any other questions, please? I think we'd possibly run out of time, so maybe a bit difficult now. So overall, it's been a very, very information-packed session. Both the speech by Mr. Soumya Mahapatra on international financial trends in trade and currency, and the talk by budget analysis by Mr. Ramji, both were extremely interesting and informative. I think the only thing that we did was maybe we should have made it into two different talks, because the scope was so much more, and trying to compress them into one session was a problem. The first speaker, Mr. Soumya, gave a very intellectual overview right from Bretton Woods agreement to the petrodollars and how the dollar is being increasingly weaponized. I think a lot of food for thought, and for people who are tracking foreign currency, I think it was an extremely informative thing. And today, many of us who are in business cannot afford to not track the way international currencies are moving, because they have such a profound impact on our businesses, whether we like it or not. Our sincere thanks to Mr. Soumya Mahapatra for taking time and then for giving us insights into the way international currency is moving. Thank you very much, sir. We really look forward to having you with us some other time. This budget analysis, as I said, I am sure even our finance minister could not have gone at such a speed, the way at which Mr. Ramji tried to cover it. The one good thing was whatever was not really important for us was not left, and some of the core areas were being discussed. So I'm sure some of the good news in the budget is still retained till the devil comes in the form of the fine print. So we hope the circulars are not taking away some of the benefits which have been given. Thank you very much.
One important thing. No, one important thing is we have reduced the budget deficit. We have reduced it to 5.9%. So to that extent, and next year the finance minister says she will keep it at 4% or something. It's a very big news, compared to
absolutely, and considering that they have tried to take care of so many segments of the economy. So sincere thanks to you, sir, and to all the participants of today's session. I'm sure you would have been benefited with the kind of takeaways that we had from both the speakers. So on behalf of CMA and its president, and on my own personal behalf, I would like to sincerely thank once again Mr. Soumya Mahapatra and our MC member and a pillar of CMA, CAM Ramji, for all the time and effort that you have taken to be with us. Look forward to having you separately some other time in the weeks to come. Thank you very much, sir. So with this, I think, can we call it off as a day? Thank you very much.
Yeah. It's my pleasure also. Thank you.
Thank you, sir.
Thank you, sir. Good night.
Good night.